Hi guys. So we're on to the last lap of your syllabus, right? Where the last lap is supposedly a little complicated, but actually it is not. Right? I don't understand why people think what is remaining is derivatives and diversification and asset and liability management, right? So it's actually one of the most easiest areas if you get the basics right. Okay, so it's very important that you understand the basics. Without the basics, it is impossible. So let's move on to derivatives, right? So what is a derivative? It's a derivative. A derivative is an instrument, a financial instrument, whose value is derived out of other variables, right? The other variables are called the underlying, which can be anything under the sun, basically, right? It's mostly financial. Can be things like interest rates, exchange rates, commodity prices, equity prices, bond prices. Can be non-financial as well. Things like even the weather, right? So you can form derivatives out of weather also. Okay, so that explains how vast this area is. A derivative is an instrument. Its value depends on or is derived from the value of other assets such as stocks, currencies, interest rates, and commodities. Right. Now, underlying, that means an underlying is the factor on which the price of a derivative is based. It can be, as I said, exchange rates, interest rates, default, bond prices, equity. And the main types of derivatives are forwards, futures, options, and swaps. Right? So we'll go into each of these. This is some basic data. The size of derivative market, massive. Right? Remember, foreign exchange market is $5.3 trillion a day, whereas the derivative market is much bigger than that. It's about 100 times bigger than the foreign exchange market. Then the next question is, why do you use derivatives? If it's so complicated, then it's said to have caused the subprime mortgage crisis. Lots of industries and institutions have fallen in trouble getting into derivatives. Right? So why do derivatives in the first place? For one thing is you can use derivatives to mitigate risk. Right? You cannot eliminate risk, but the risk you can manage, can be managed to a certain extent. Right? So for that reason, you can use derivatives to mitigate or manage your risk. Then to reduce cost, enhance returns, and allow investors to make risk with greater certainty. Right? Take on risk with greater certainty. Now, for example, why would you? What is the first thing you do when you purchase a vehicle? You go and get it insured. Why do you do it? Well, because insurance is also a kind of derivative. So why do you do it in the first place? Because in case you meet with an accident or you meet with a loss, then the insurance policy will compensate you. Now, it's not that you are guaranteed of meeting with a loss or incurring a loss, right? In case you incur a loss, the insurance policy will bear the loss. Okay. Then it's also used for speculation. Derivatives can be used to speculate, meaning you can try and make arbitrage profits, or you can make profits using derivatives, right? You can, for example, buy at a lower price and sell it at a higher price and make a profit, or you can short sell. If it falls, the price of the derivative falls, you can buy it back at a lower price. So you can speculate. Again, the bigger market is the speculative market, even with derivatives. Then how do you mitigate risk? Fluctuations in all kinds of financial prices, including foreign exchange, interest rate, and commodity prices, can affect our earnings, right? So volatility has an impact on earnings, can be a positive impact or a negative impact. Therefore, you need certain instruments to mitigate these risks, which can be facilitated through derivatives. Derivatives are used to hedge risk, to speculate, to take a view on the future direction of the market, then to lock in an arbitrage profit, to change the nature of a liability, right? So if you're paying, for example, a fixed rate of interest and you see interest rates falling, then you can use the derivatives, what is called a swap, to go from paying a fixed rate to paying a floating rate. And to change the nature of an investment without incurring costs of selling one portfolio and buying another. right? So you can switch from a fixed income portfolio to an equity portfolio without actual physical movement of securities. You need to use derivatives with care because there is a possibility of incurring large losses. Some of the examples are given where AIG lost $18 billion, right? And the Federal Reserve had to capitalize it. This was during the subprime mortgage crisis. Now, AIG is one of the largest insurance companies in the world, almost went bankrupt because of derivatives. $18 billion, massive. It's about 1/5 of our GDP. SG, misuse of financial futures, incurred $7.2 billion. Then also, if you can remember Barings Bank, see what Nick Leeson did to Barings Bank. Again, that was also because of derivatives. Wrong use of derivatives. In the wrong hands, derivatives can cause a lot of trouble. Then hedge funds, there's also another example. So go through these. And there are even local examples as well. Derivatives can be exposed to counterparty risk, right? So counterparty risk is very important when you get into derivatives. So one of the first things you need to do if you're doing derivatives is to evaluate counterparty risk or the credit worthiness of your counterparty, right? So it's as good as giving him a loan. Then there's a high risk for small, inexperienced investors. If you're small, if you're inexperienced, then you might end up losing. An inexperienced classic example is even in Sri Lanka, we saw also what happened with CPC, right? So unfortunately, there are still court cases pending. So that is also an example of derivatives, where derivatives can cause losses. And with losses, sometimes you might even experience reputation risks, right? Your reputation might go for a 6 if you don't settle on time. Massively leveraged. Massively leveraged. Derivative positions can be leveraged to a great extent. I think I explained what leverage means. It's without actual funds, you invest in a bigger position. It's called leverage. So derivatives can be leveraged in large notional values, right? So notional value is the base value on which derivative calculations are made. The notional values in derivatives can be massive. Certain categories of derivatives, you have all types of derivatives: interest rate, commodities, equity prices, foreign exchange, credit default. Credit derivatives, now credit derivatives get triggered in the event of a default, right? So if there's a default, then it's called, the actual instrument is called a credit default swap. Okay, so actually credit default swaps get triggered if there's a default. In the instance of a default, subprime mortgage crisis was almost purely caused by credit default swaps getting triggered. Credit risk is the risk that promised payments on an obligation will not materialize. Credit derivatives is a class of financial instruments, the value of which is derived from an underlying market value driven by credit risk of private or government entities other than the counterparties to the credit derivative transaction itself. These are the products. Then interest rate derivatives. They derive value from some money market instruments or reference interest rates. And so the underlying in this case is an interest rate. Types of interest rate derivatives have been given. So in each type of derivative, you have forwards, futures, options, and swaps. Right. So the idea is to understand these 4 types of derivatives. What are forwards, what are futures, what are options, and what are swaps. Commodity derivatives, the underlying asset is a commodity. Again, you have forwards, futures, options, and swaps. Equity derivatives based on the underlying is equity, share price movements. Same products. Foreign exchange, the underlying is foreign exchange. Right, so these are the classifications of derivatives: forwards, futures, options, and swaps. Right, so let's get cracking on options. Right, it's actually very interesting. Now, Nick Leeson, if you all could remember, was trading in futures, and he ended up doing a straddle, which is purely based on options. Right, so we'll just discuss what options are. The basic definition of an option is it gives you a right without an obligation, right? So it's a product where you have a right but no obligation. So if you want, you can go ahead. Otherwise, if you don't want, you can forget about it. And so these are the basic features of an option. It gives a right but not an obligation to buy or sell a predetermined amount of the underlying against a fixed price until or on a future fixed future date. Right. Now let's take an example. Today is 4th of April. Let's say 30th June. Let's say you need to buy mangoes. You need to buy one mango. The price of a mango, let's say, call it the spot price of a mango. Spot price of a mango, let's say, is 100 rupees. Then on 30th June, if you want to buy a mango, right? You feel the price of mangoes might not be the same. You're not sure what is going to happen. So you want to fix the price of a mango today itself without waiting until 30th June. So you come to me and you ask me at what price I can sell mangoes to you, right? So you're buying mangoes from me. Then I will tell you that I will sell mangoes on 30th June at a price of 150 rupees. Right? So on 30th June, you can buy mangoes from me at 150 rupees. Then I also give you a benefit. On top of this price, I will tell you if you want, you can buy from me. Otherwise, you can forget about this and you can buy from the market. Right? So I have given you a benefit. Meaning, if you want, you can buy from me at 150, or if you want, you can buy from the market. If it's cheaper, you will obviously buy from the market. If the market is going at 100, you will not come to me. You will go to the market and buy. And so I have given you a benefit. Now, for that benefit, there is no free lunch in finance. Right? So what I do is I will charge a price. Let's say I will charge 10 rupees from you. Today itself, I'm charging 10 rupees. Now, this is the cost of your benefit. Huh? You have to pay me 10 rupees today itself, upfront. Right. So on 30th June, if the price of a mango is, let's say, 100 rupees in the market, price of a mango, actual price of a mango is 100 rupees in the market, then you will not come to me, right? Because you can buy from the market at a cheap price of 100 rupees. You don't have to come to me and buy it 150. Okay, so you're not going to go ahead with the transaction with me. Right? You will just buy from the market and forget about it. Even at 120, it's cheaper to buy from the market. So you buy from the market, you won't buy from me. Then if the price is, let's say, 150 rupees. Okay, it doesn't make a difference. Then you can either buy from me or from the market. Both will cost you 150 rupees. Now, in these three instances, you have anyway paid the 10 rupees upfront. This is the fee that I am charging. 10 rupees you're paying me today. And the product that you have purchased from me is an agreement to buy mangoes on 30th June at a price of 150 rupees. Right? So whether it's 100 rupees, 120 or 150, you may or at 150 you may or may not exercise this, but less than that, you're definitely going to buy from the market. You're not going to use the contract with me, right? So if this is the case, the contract with me will not be used, and you will lose your 10 rupees. You will lose 10 rupees. Because you have already paid me the 10 rupees. Then at 155, if the price of a mango on 30th June is 155, right? If it's 155, then you will come to me and buy at 150. No? Why? Because I'm still offering 5 rupees less than the market, right? You can buy from me at 150. If you buy from the market, you can buy at 155. Okay, so you will come to me and use this contract, and you will save 5 rupees. 5 rupees saved. But you have paid me 10. So your profit at this point is minus 10. which is what you paid me, plus the 5 rupee profit. You will end up losing only 5. Then at 160, you will buy from me at 150. And you will save 10 rupees, but you have paid me 10. So minus 10 plus 10, you will break even. 170, you will come to me and buy at 150. You will save 20, but you have paid me 10, so you will save a net of 10. You make a profit of 10 overall. There are 200. You buy from me at 150. You save 50. You have paid me 10 to make a profit of 40. Okay, so likewise, this can continue. Higher the price, higher the profit you make. Right? So now let's plot a small diagram. And we'll put your profit against the market price. Until 150, until the price of a mango hits 150. Right, this is market price. Until it hits 150, you will be losing. Then at 160, you break even. Right. And at 200, a bit of what we call, this is not down to scale. Right. Okay, so this is how it works. Now, so let's look at this analysis once again. Price of mango today is 100 rupees. That is called the spot price. Then the fee that you pay me is called, when you buy insurance, you pay a premium, right? You need to pay a premium. So this is called premium. 150 is called the strike price. 30th June is the expiry date. These are the technical terms. Very easy to remember. 30th June is called expiry date. That is when you decide whether you are going ahead with the transaction or not. And 150 is the price of 150, the price, the decisive price. Yeah. Right. Okay. Now this is what customer will do with me, right? Okay, I'm giving him this benefit of selling mangoes at a price of 150, but I charge a price of 10. Everything in finance is a zero-sum game. Even this is like that, right? When the customer makes a loss of 10, when he loses 10, I will make this premium, right? I will make money on it. I will make a profit of 10 because I get the premium, I collect the premium. So his loss is going to be my profit. And his profit will be my loss. But 160 is both break even. And at 200, I make a loss of 40. Okay. Right. Now in this case, I have sold the contract to another party. That party has bought the contract from me. If you have bought a contract, if you have bought this contract, you are long. And if you have sold this contract, you are short. So two sides of the contract, long and short. Can either be long or short, the contract. Now the profit, right? If you are long, the profit will be, in this case, it is the market price minus premium. Sorry, market price minus strike price minus premium. Market minus strike minus premium. Okay, so market minus strike is called the intrinsic value. Market minus strike is called intrinsic value of an option, which will always be positive. It can never be a negative number. Right, so this is the profit. If you're long, this will give you the profit. Then, if you're long, your maximum profit, if you're long, your maximum profit can be infinite, right? Because the price of a mango in the market can technically go to infinity. So maximum profit will be infinite. Then your maximum loss. If you're long, your maximum loss is, in this case, 10, which is the premium. Maximum loss is premium. If you're short, maximum profit if you are short will be 10, right, which is the premium. And the maximum loss will be infinite. So it's the mirror image. Both diagrams, long and short mirror images, likewise maximum profit, maximum loss, also mirror images. Right. Now, if you look at this diagram, if you analyze this further, you will notice that there are three regions, three distinctive regions. If I draw a line across the strike price, below the strike price, this contract will not be used. And so this is called out of the money. When the market price is equal to strike, it's called at the money. And when the contract is being used, it is called in the money. Three zones. If you look at this product, it gives you the right, without an obligation, to buy mangoes on 30th June from me at a price of 150. Right? And you're paying a premium of 10. Now, a product which gives you the right, without an obligation, to buy, in this case, mangoes, but in general, it's called an underlying. Right? A product which gives the right, without an obligation, to buy the underlying is called a call option. And so this entire thing is called a call option. Call option. It gives the right, but no obligation to buy the underlying. So this is the long and short of the call option. Very simple. This is the basic. If you understand this, you understood call option. Right, so these terms we discussed, exercise price or the strike price. Right? So strike price is also called exercise price. The underlying asset, now in this case, the underlying asset was a mango. Okay, so all calculations are based on the price of a mango. The option price is called the premium. Option premium. Right, always the option buyer sells the option to the option seller. Right. The easiest way to understand is when you buy insurance, you have to pay a premium to the insurance company. So the insurance company is selling the insurance to you. You are the buyer, the insurance company is the seller. Right. An option premium represents the price paid by the buyer to the seller to assume the price risk of the underlying. So in that case, the insurance company is taking the risk. So you have to pay the insurance company for the risk that they are assuming. Right? It's not the other way around. The insurance company will not pay you. You have to pay the insurance company for the risk. Right? And you have a right without an obligation. You have a right without an obligation. Whereas if you decide to exercise your right, then the counterparty or the insurance company, that example, has an obligation. Right? So you have a right without an obligation. The counterparty will have only an obligation. Okay, so the long has a right without an obligation, whereas the short has only an obligation. Okay, so the buyer is called the holder, seller is also called right of an option. Yeah, so there are two types of options. Before we get into American options, I hope call options were clear. You can't see the board. Better, is it? Can you all see the board now? Left side, this the side I have written. Because my left, there is nothing written. Better or is it the same? Can you all see now? So hope you can see the board now. Right. We just discussed call options. Right. Now this is if you wanted to buy a mango from me. But what if you have a mango plantation and you want to sell mangoes? Today is 4th April. On 30th April, 30th June, you want to sell mangoes. Right. Again, let's assume today's spot price of a mango is 100 rupees. Okay. So you're expecting to sell mangoes on 30th June. Then you come to me and ask me at what price I am willing to buy mangoes from you. Right. So I will tell you that I will buy mangoes from you at a price of 80. 30th June, I will buy mangoes from you at a price of 80. Right. But I give you a small benefit. I will tell you, if you want, you can sell mangoes to me on 30th June at a price of 80. Otherwise, you can just sell it in the market. You don't have to come to me. Right? So I have given you a benefit. For this benefit, I will charge you. No free lunch. For the benefit, I will charge you. Again, it's called the premium. And say the premium in this case is 5. Right? I will charge a premium of 5. Now, on 30th June, if the price of a mango in the market is 100 rupees, price of a mango in the market, if it is 100 rupees on 30th June, then you will not come to me. Right? Because if you come to me, you will sell mangoes at 80, but now you can sell mangoes at a price of 100. Right? So obviously, you will not come to me, you will sell it in the market. Meaning you will not use this contract. Right? But you have already paid me 5, that is sunk cost. Then at 90, you will lose the 5. At 90 also you will sell it in the market, you won't give it to me. Therefore, you will lose the premium. And at 80, you can either sell it to me or you can sell it in the market. I will sell it to me at 80 or you can sell it to the market at 80, indifferent. Either way, you will lose 5. Then if the price of a mango in the market is 75, you will sell it to me at 80. Because if you sell it in the market, you will only get 75, you will sell it to me. Right? You will get 80 and you make a profit of 5, right? Because your market price is 75. Without selling it in the market, you sell it to me at 80. So you have a 5 rupee benefit. But you have already paid me 5. Right? So that's 5 rupee benefit minus what you paid, you end up with 0. Then at 70, again you will sell to me. I will buy mangoes from you at 80. So you have a 10 rupee benefit. Right? But you have paid me a premium of 5. So you make a profit of 5. Then at 50, you sell it to me at 80. You will make a profit out of that of 30. 80 minus 50 basically. Then at 10, you sell it to me at 80. You make a benefit of 70 minus 5. Then if mangoes become worthless, right? If mangoes become worthless, you will obviously sell it to me at 80, and then you will make the full profit. minus what you paid me, you will end up with 75. If I plot these results on a graph, remember I have sold you the contract to sell mangoes back to me. And you are going to sell mangoes to me this time. Here, the previous contract gave you the right to buy mangoes. Now you want to sell mangoes. So again, let's drop the profit, plot the profit against the market price. When the price is 100, you lose 5. When it is 9, sorry, when it's 100, you lose 5. When it's 90, you lose 5. And when it's 80, you will lose 5. But when it's 75, you will break even. At 75, you break even. At 0, you make a profit of 7. In this case, I have sold this product. I have sold, so I am short. Right? This is for the long. So when the long makes a profit, I make a loss. When the long makes a loss, I make a profit, right? Meaning below 75, I will lose. So at 75, I will break even. This is what it will look like. And this is for the long, and here's the short. Yeah. Now these diagrams, both of these diagrams, they are called payoff diagram. Okay, so this is the payoff diagram. Of a call option, whereas this one is the payoff diagram of a put option. Yeah. And if you are long, your profit will be profit calculation If it's strike minus the market minus premium. With the strike of strike is 80, expiring 30th June. Whereas your maximum profit is when the market is 0. Sorry, before that, strike minus market once again is called intrinsic value. It will always be a positive number. It can never be negative. The maximum profit is when market is 0, so it's strike minus premium. Whereas in the call option, maximum profit was infinite. Again, maximum loss. If you're long, the maximum loss is going to be 5 rupees is the premium, premium of 5. Then if you are short, your maximum profit will be the long's maximum loss, which is the premium, and your maximum loss is going to be the long's maximum profit, which is strike minus premium. So I hope that was clear. Again, if you mark the 3 regions in this, if you draw a vertical line at strike price, anything more than the strike is option is not going to be utilized, so this is out of the money. Option strike is equal to market is at the money, and if the market is less than the strike, it is in the money. So these are the 3 regions. Okay, American and European options. By the way, the second option that we did gave you the right without an obligation to sell mangoes. Right? The underlying is again mangoes. It gave you the right to sell the underlying. Now, an option which gives you the right without an obligation to sell the underlying is called the put option. So this is all about the put option. This is all you need to know about put options. Okay, so this is call option. Here you get put options. If you know this, you know everything about options. Right, so there are two main types of options, now call option and put option. There are also two types of options based on when you can exercise the option. Right? Two types of options based on when you can exercise an option. Now, there are certain types of options where you can only exercise at the maturity date. Okay, those kind of options can only be exercised at maturity date. Then other options are there where you can exercise anytime before it matures. The former, where you can exercise only on maturity, is called a European option. Right? It's not flexible. Whereas the latter, which can be exercised anytime before it matures, is called an American option. Two types: European option only on expiry date, American option anytime before it expires. Right? Usually, Americans are more flexible than Europeans, and so that's the easiest way to remember it. But American goods are more expensive. So put options, American options are more expensive than European options because it's more flexible. More flexible, meaning it gives you more benefits. So if it gives you more benefits, if there is no free lunch, you would pay more for it. Right? So American options are more expensive than equivalent European options. An option which gives you the right to buy is called call. Option gives you the right to sell is called put. And call option and put option, what we discussed. Right, in the money, out of the money, and at the money, again we discussed. And then comes the inputs for pricing options. Right, so what are the inputs that are used to price options? Okay, now take a simple vehicle insurance. This is the easiest way to explain. If you take a vehicle insurance, the insurance premium, right? Now pricing an option is called option premium. How do you calculate option premiums? I will draw a parallel using insurance. Insurance, if you take a vehicle insurance, the more expensive the vehicle, higher the premium, right? Take, for example, maybe a three-wheeler or a motorbike against a brand new Mercedes-Benz. The Benz will have a higher premium, right? Then also the exercise price or the strike price also has an impact on the premium, right? Because higher the exercise price, higher the premium for put options, and lower the exercise price, higher the premium for call options. Interest rates have positive relationship because higher the interest rate, higher the option premium. Time to expire, again positive relationship. And longer the time duration, higher the uncertainty, so higher the premium. Then volatility. Now, volatility means the risk, right? Risk. So if the risk is high, then your premium will also be high because these are used to hedge risk. So if the risk is high, you have to pay more to hedge your risk. Inputs, the spot price. I'm going to compare each of the inputs and the impact they have on the call option premium and put option premium. Spot price. When the spot price is low, what is the impact on premium? Okay, so that's what we're going to analyze. Then the strike price, time, interest rates, and volatility. Okay. Right. So when the spot price is low, and if you look at call options, they give you the right to buy. Now you will prefer to buy at the lowest possible price rather than buying at highest possible price. So buying at a low price is a privilege for which you need to pay, right? Which means lower the spot price, higher the call option premium. So there is an inverse relationship. Inverse relationship. Whereas put option gives you the right to sell, and you will prefer to sell if the price is high. And so selling at a high price is a privilege. The higher the spot price, higher the put option premium. Right? Put option premium will be high. Higher the spot price, higher the put option premium. So it's a positive relationship. Then again, strike price, call options gives you the right to buy. You will prefer to buy at the lowest possible price, which is a privilege. So lower the strike price for call option, higher the premium. Lower the strike price for call option, higher the premium. It's an inverse relationship. Put options gives you the right to sell, and you will prefer to sell at the highest possible price. So if the strike price is high, put option premium will also be high, right? So high strike, high option premium. Positive relationship. Long time period. Now, if you're getting 1 month insurance and if you're getting 12-month insurance, the 12-month insurance will cost you more. So longer time period has a premium. So it's called or put. Interest rates, higher interest rates, higher the premium. Positive relationship. Volatility, higher the risk, higher the premium. Then positive relationship. Okay, now if you look at this carefully, you will notice that both spot and strike are something to do with price. Right? Everything has positive relationship except a call option premium when it comes to the call option price, right? Call option premium. So everything positive relationship except call option premium against the spot price and the strike price. That's anything to do with price of call option has negative relationship. Everything else positive relationship. Okay, so all factors positive relationship except a call option, spot price, and the strike price. Yes, I hope that was clear. Any questions up to now? Right. Option settlement can be, well, option settlement, you need to look at the expiry date, the settlement date. Then there's something called a Tokyo cut, New York cut, Singapore cut, and London cut, and all that. So what does it mean? What it means is, now if you take a particular day, right now in this case we are discussing mangoes. No? So 30th June mango price, the price of mango on 30th June. Now on 30th June, right, if it's the call option example, strike price we put at 150. So if the price on 30th June at 10 o'clock in the morning is 200 rupees, then you will exercise the option, right? But evening, if it falls to 100, if it falls to 75 rupees, you will not exercise the option. So at what time do you decide you're going to go ahead? That needs to be specified in advance, right? You should say New York time or New York cut, 6 p.m., something like that. Right. So it gives you exactly when you're going to use the contract. And physical delivery versus cash settlement. So if you are buying mangoes in this case, right, you can do either physical delivery or cash settlement. A physical delivery is very obvious. No? That is where you give an actual mango, right? 30th June. So if you have sold call options, by the way, one thing I forget to mention is if you look at the maximum loss of call option and put option, right? Maximum loss you can make on a call option and a put option, maximum loss comes when you sell options, when you sell call options, because the loss in that case is infinite. And technically, you can use unlimited amount. So the riskiest thing you could do with option is to sell or go short put options. So sorry, go short call option. Right? In other words, write a call option. That is the riskiest thing you can do. It's like financial suicide. Right, so again, option settlements, yeah, you can do physical delivery or cash settlement. Right? So physical delivery means now on 30th June, if the buyer of the option comes to me, buyer of the call option from me comes to me and asks for the mango, I can either give him an actual mango. On 30th June, I give him a mango at 150 rupees. So I can do physical settlement. That's physical settlement. Cash settlement means if the market is 200 rupees and if he's buying from me at 150, he will save 50, isn't it? Right. So without getting him to pay me 150, and me giving him a mango, what I can do is, understood? Because this is a call option on mangoes, the strike price 150 on 30th June. So 30th June, if the price of a mango is 200 rupees, he will come to me and buy. Now there are two ways for me to settle the transaction. Either I can give him a mango on 30th June and he will pay me 150 rupees, or the net of this is 50 now. So doing anything, I just give him 50 rupees. Right? So it means I have bought a mango from the market at 200 rupees and sold it to him at 150. So I will book a loss of 50 rupees. Right? I will book a loss of 50 rupees. But on the other hand, is if I give him a mango at 150 rupees, that guy can sell mangoes on 30th June at a price of 200 rupees. He will make a profit of 50. Right? So I will make a loss of 50, he will make a profit of 50. Now, without doing all that, if I simply give him 50 rupees at the expiry date, that is as good as settlement of the transaction. It's called cash delivery. It's called cash delivery. It's another way of settling options, derivatives. Okay, so let's try these questions. Let's try this question. Calculate the value of the following put options and draw payoff diagrams. Long, strike price 100, premium 4, stock price 90. Second one is short, strike price 100, premium 4, and stock price 110. Okay, so it's as simple as it gets. Let's take a minute and try the question. On this payoff diagram, you need to memorize because they're standard. So you asked to calculate the value of the following put option, then draw payoff diagrams. And first thing is draw the standard put option payoff diagram, like long put. This one is long. So let's draw the diagram and mark the regions. Right, so put option. Profit. And here you have market. First one is long put, strike price of 100, premium of 4, and stock price is 90. So the profit will be the strike minus market minus premium. Strike 100, market 90 minus premium of 4, 10 minus 4, $6. We make a $6 profit. Next one. Short. Put option short. Strike price 100. Premium 4. Stock price 110. So this is an out of the money option, isn't it? Because the previous example, strike is 100, put option, market is 90. Actually, it's in the money, which is why you get 6. But when it's out of the money and you're short, you only get the premium. Right? You collect the premium. In this case, the profit is $4. At 110, you collect the premium. Next one. Calculate the value of the following call options. First one is long, call options long. Strike 100. Premium 4. And stop price is 90. Okay, so at 90, call option is out of the money, meaning you will lose your premium. Your profit is $4 negative. Because at 90, you lose the premium. Next one is short. Strike price 100. Premium 4. Stop price 110. It's in the money. That's it. It's in the money. So if you're long, your profit will be market minus strike minus the premium. It's like 110. Profit will be market is 110 minus strike 100 minus the premium 4. 10 minus 4, $6. Right, but here you are actually short. Right? You are not long, you are short. So the profit is the mirror image at 110. It's negative 6. Next question. Sri Lankan exporter will receive 1 million yen in 3 months. So he's a Sri Lankan based exporter. He's exporting maybe to Japan and he's going to receive 1 million yen in 3 months. He expects the current yen rupee of 84 to increase to 90, right? So it's meaning the yen is expected to strengthen against the rupee, which is good for him. So if it's good strengthen, why does he have to hedge? Right? Because there is no guarantee that the exchange rate will actually move to 90. There is no guarantee. No one will know what the exchange rate is going to be. And so if it goes up, it's good, well off. But in case it comes down, what is he going to do? So question is, what is the protection that he can get from an option strategy if his view does not materialize and the yen rupee does not increase, right? So if the yen rupee does not increase, what protection does he have? Well, what he can do is now he is receiving yen, which he needs to sell, right? And the market is expecting the yen rupee to increase, which is good for him. So if that is the case, then he needs to cover the downside. The downside risk needs to be covered. So what he can do is he needs to buy an option which gives him the right to sell yen and buy rupees, right? So an option which gives you the right to sell is called a put option. So he needs to buy a put option on the yen rupee, right? Buy a put option on the yen rupee at a strike price of maybe 75, depending on his risk appetite. So why a strike price below the current spot price, because you need to buy always out of the money options. If you buy an in the money option, it will be very expensive. Premium will be very high. So what you need to do is to buy an out of the money option, right? So if this guy buys an option, put option on the yen rupee, with on the yen yen rupee, put option on the yen rupee, right? With a strike price of 75, means the lowest he will be selling yen is 75. So it can be lower than that. He will also benefit if the market goes up. Right. Then option premium, it's the total of intrinsic value and time value. Right. Intrinsic value, if you all could remember, for a call option, it is the market price minus strike, and for the put option, it is strike minus market. That will be never negative. Option premium is the intrinsic value plus time value. Time value is the value that it gets due to its time period to expiry. An option is usually never worth less than what the option holder can receive if the option is exercised. Intrinsic value is the difference between the price of the underlying and the strike price of the option, right? An option holder, the first point, option is usually never worth less than what an option holder can realize if the option is exercised, which is why you should never buy an in the money option, because it is not going to be worth less than that. The intrinsic value is the difference between the price of the underlying and the strike price of the option, or the in the money portion of an options premium. Time value is a portion of an options premium that is attributable to the amount of time remaining until the expiry of the option contract. Any premium that is in excess of the option's intrinsic value is referred to as its time value, right? Anything above intrinsic value is referred to as time value. As a general rule, the more time that remains until expiry, the greater the time value of the option. This is because investors are willing to pay a higher premium for more time, since the contract will have longer to become profitable due to favorable movements in the underlying. Time value decreases over time, eventually decaying to zero. It's called time decay, right? Remember, option has two components. Option premium has two components: the intrinsic value and the time value. So let's try this example. Following prices were reported in June 2014 and December 2014. Call options on the shares of ABC, right? The price of a December 2014 call option is 35.75. Strike price is 66. Spot price 80.75. You asked to calculate intrinsic value and time value, and to comment whether the option is in the money. Price of option 35 75. Strike price of the call option 60. Spot price is 80.75. Intrinsic value. A call option is the market, for this case the spot, minus the strike. Intrinsic value is $1475. Time value. Like it's using this one. The premium minus intrinsic value. Premium 35.75 minus intrinsic value 14.75. It's 21. Right. So intrinsic value is the spot price minus the strike price, spot 80.75 minus strike 66. You get intrinsic value of 14.75. And from this equation, the time value is equal to premium minus the intrinsic value. Like premium 35.75 given minus intrinsic value 14.75. You end up with a time value of $21. Right. And what it says is as time approaches 0, as it approaches expiry, the time value drops to 0. And so at expiry, the premium will be equal to intrinsic value. Now, if you look at the premium, it is intrinsic value plus time value. So even if time value is 0, the option will be worth the intrinsic value if it's in the money, which is why you should never buy in the money options, very expensive. Price sensitive of an option, right? The option price is sensitive to many factors. Now, if you could remember, the price of a bond is sensitive to interest rates measured by duration. Likewise, the price of an option, meaning the premium, is sensitive to various inputs, right? Like the underlying price, like interest rates, volatility, time, and that kind of factors, right? So how do you measure the option's price sensitivity? Now, delta measures the sensitivity of an option price to change in the underlying price. How does the option price change when the underlying price changes? That's called delta. Gamma, it measures the sensitivity of delta to changes in underlying prices. Right? By how much is the delta, which is the sensitivity of the option price to change in underlying price? Right? How does delta change when the underlying price change? That's called delta. So that's called gamma. Then theta is the sensitivity of the option price to changes in time. When time period changes, how does the option price change? Theta. Right? Gamma is we discussed. Sorry, rho, the changes in the option premium to changes in interest rates. When interest rates change, how does the option price change? Measured by rho. And finally, vega, the sensitivity of an option price or the premium to changes in the volatility. When volatility changes, how does the premium change? That's measured by vega. These are easy to these are called option Greeks. And they're actually called Greeks, not because no one understands, but because these are data Greek letters, right? This is part of the Greek alphabet. Delta, gamma, theta, rho, and vega are parts of the Greek alphabet. That's why they're called option Greeks. Now, easy to remember because all you need to remember is the sensitivity of option price. Everything measures the sensitivity of the premium to changes in various factors, like delta and gamma measures changes in the premium to changes in underlying price. Theta changes in the premium to changes in time. Now, theta and time both begins with T, so it's easy to remember. Rho measures interest rates, right? So R, right? R denotes an interest rate. So option premium to changes in interest rates measured by rho. And vega starts with V and it measures the sensitivity to volatility. Again, easy to understand, easy to remember, sorry. Sorry, Jani, did I miss part of the question? Oh, sorry, yes, part B, I missed it. Is the option in the money? It's a call option which has a positive intrinsic value, right? Intrinsic value is positive. So if intrinsic value is positive, that means it is definitely in the money. Why is intrinsic value positive? Because you get a positive of 1475. Huh? If it's positive intrinsic value, that means it is in the money. Okay, thanks. Sorry about missing it. The option strategies. How do you combine options to form various strategies based on market movements? Right. So buy a call or a put. Let's go to the strategy straight away. First one is called a straddle. Now, a straddle is by a call option and a put option at the same strike price. Call option and a put option at the same strike price. That is called a straddle. And straddle will make you money if the market is volatile. If it's stable, you will lose money because you're paying very high premiums on both the call and put options. So for you to make money, the market has to be volatile. Now, this is where Nick Leeson went wrong because he thought the market is going to be stable. So he went short straddle. But when the earthquake struck, the market became very volatile and he started losing money, right? So this is straddle. Then next one is strangle, going long call option and a put option at different strike prices, right? Call option will have a higher strike, put option has a lower strike. So for that reason, a strangle is cheaper than a straddle. Strangle is cheaper than a straddle because it is not at the same strike price at different strike prices. Spreads. A spread is a position entered by buying and selling equal number of options of the same class on the same underlying security, but different strike prices or expiry dates. So there are two kinds of spread: bull spread and bear spread. A bull spread will make you money if the market is going up. It is a spread which is defined to profit from a rise in the price of the underlying security. Right here, you buy a call option at a lower strike, and you buy a put option, buy a call option at a higher strike. You buy a call option at a higher. I'll repeat. You buy a call option at a low strike, and you sell the call option at a higher strike. That is called the bull spread. The bull call is a spread is constructed by buying a call option with low strike and selling another call option with a higher strike. So if the market goes up, you make money, but not beyond the short call strike. Bear spread, if the market falls, you make money. Here, you buy a put option at a high strike and you sell a put option at a lower strike. You can also construct using call options. You buy a call of a strike price and selling the same number of calls at a lower strike price on the same underlying security with the same expiry month. Butterfly spread, right? You buy a call option at a low strike, sell two call options at an intermediate strike, and buy a fourth call option at an even higher strike. In this case, if the market is stable, you make money, unlike in a strangle. View is the market will be traded in a range. Buy an option, call or put at low strike price. Sell two options at a high strike. And finally, buy another at an even high strike. Next is hedging with options. How to hedge an underlying position? You purchase a call option to protect the short position. You purchase a put option to protect the long position. So let's try this example, then you will understand better. A Japanese importer has to pay $2 million in 3 months, right? So Japanese importer, he's based in Japan, he's importing from the US, meaning he has to buy dollars. The current dollar yen rate is 90, and he thinks that the dollar yen rate will decrease to 85, right? So if it's 90 now, if it falls, he will benefit because he has to pay less yen to buy the same amount of dollars. But his risk is the yen and the dollar yen rate going up, right? So if it goes to 100, then he will lose. What can he do? He needs to buy a call option on the dollar yen, right? On the dollar. So he needs to buy a call option on the dollar yen pair, right? So you need to be very specific. Tell him exactly what he has to do. Don't give bits and pieces answers. Huh? He needs to buy a call option on the dollar yen. Right? Maybe at a strike price of 100, so that he's buying an out of the money option. So if he does that, and if the market goes up, he is capped at 100. But if the market comes down, he will benefit. If the yen depreciates to 100, he needs to buy more yen to buy $2 million, right? So he can buy a dollar call yen put with a strike price 95 expiring in 3 months. If the market goes lower, he buys dollars cheaper. He can forget about the option, can let it expire, and he can buy dollars at a cheaper price. If the market goes against him, he is protected by the call option. Okay. In hedging with options, next example, hedging with options. Sri Lankan exporter with dollar receipts in 3 months. The current dollar rupee rate 134.25, 3 months forward 40 cents. Right? So spot rate 134.25, and the premium 3-month premium is 40 cents. What to get the outright 3-month rate, you need to add the spot rate to the premium. So it's 134.25 cents plus 40 cents, 134.65. And Sri Lankan exports dollar receipts in 3 months, so he needs to sell the dollars eventually, meaning he has to buy an option which gives him the right to sell. Okay, so he has to go long a put option on the dollar yen. So engage in a forward contract to sell dollars at 134.65, thinking the dollar will drop against the rupee. If he thinks that the dollar will trade high against the rupee, he will do nothing. He doesn't have to do anything. All he has to do is to wait for it to go up and sell. Then using option strategies, the Sri Lankan exporter with dollars in 3 months can buy a dollar put rupee call at a strike price 114. Okay. If the market goes against him, he's protected by the dollar put rupee call option. Yeah, so if the market falls, he's hedged to a certain extent. He might not be able to completely eliminate the risk, but still he will end up better off than where he was. stock of A is trading at 100 rupees and the fund manager sells 110 rupee calls for a premium of 1. The fund manager will forfeit participating in the upside potential above 110. Right? He has sold 110 rupee calls for a premium of 1 rupee. Right? For 1 rupee premium, he has sold call option with a strike price at 110. Meaning if the market goes above 110, his call options will get excised. So he will have to sell. He has an obligation to sell at 110. As he has bought at 100, he has received a premium of 1. So effectively, the cost is 99. Now his upside is only limited to 110. If it goes beyond that, he does not benefit. If the stock remains at the same level, he will have to collect at a premium of 1 rupee. By selling calls, entering the premiums, he can effectively lower the cost of the stock. Okay. So effectively, he has reduced the cost of the stock from 100 by 1 rupee to 99. The strategy is good only for the stable and range trading market. If the market moves down, he has to sell the stock at a much lower price, right? So there is no guarantee that it will go up. If it goes to 80, he will have to end up selling at 80. And then he has paid a premium of 1. He has received a premium of 1. If the prices trade higher, he will have to buy back the stocks at a higher price. Next one is zero cost options. Now, remember the straddle? You went long call, long put. But what if you had gone long call, short put, or the other way around? Short call, long put. Right? You're combining two types of options. When you buy a call option, you have to pay the call option premium. And when you sell a put option, you receive the premium. Right? So that's called a caller. Then if the call option premium is equal to put option premium, you break even. The hedger desires the limited risk offered by buying an option, but wants to avoid cash outlays. So he combines it with the purchase of an option with the sale of another. Like long call, short put. In our previous example of dollar rupee at 114.25, if the view is dollar is going to go lower, you buy dollar put, LKR call at 113, and simultaneously sell dollar call, LKR put at 116. Right? You buy dollar put, rupee call at 113, and sell dollar call, rupee put at 116. Premium for buying dollars is 113, can be reduced by the sale of dollars of 116. Then you can adjust the strike price to such that the premium is equal to premium received and paid are equal. That's called a zero cost collar. Okay, so that's about options. Any questions on this? Right, so let's move on to the next area. Forwards, we have done exchange rate forwards. Remember the forward rate calculation? Forward is equal to spot into 1 plus the interest rate of counter currency divided by 1 plus interest rate of base. Okay, so futures contract is similar to a forward. Forward contract is an agreement made today between buyer and seller who are obligated to complete the transaction at a date in the future. The buyer and the seller are known to each other. Right? So this is the basic feature of a futures contract. It happens on an exchange. And the benefits of happening on an exchange is everything is standardized. You can't give lower standard products, right? So everything is standardized. That standard has to be maintained. Then the settlement is also guaranteed. Everything about that contract is guaranteed. Right, from the weight, the height, the quality, everything has to be certified. Forward contracts. Forward contract is price at which the trade will occur is also determined when the agreement is made. So forward contracts are binding contracts. You can't reverse them once you enter into it. One party faces default risk because the other party might have an incentive to default on the contract. To cancel the contract, both parties must agree. One side might have to make a dollar payment to the other to get the other side to agree and cancel the contract, right? So it's difficult to reverse a forward contract. And futures contract, futures is an agreement made today between the buyer and seller who are obligated to complete a transaction at a date in the future. The buyer and the seller do not know each other, right? So they never meet. The negotiation occurs in the fast-paced frenzy of a futures trade. Now, this is why you need to watch Rogue Trader, because Nick Leeson was trading on a futures exchange. In terms of a futures contract as standardized, what to trade, where to trade, when to trade, how much to trade, everything is standardized. Everything is standardized. You can't customize. Financial futures are usually cash settled. All the physical delivery is not impossible. The price at which the trade will occur is determined in the pit, which is known as the futures price. No one faces default risk, right? So default risk is nothing that you need to worry about. Even if the other party has an incentive to default on the contract. And so there is no default risk whatsoever. Futures exchange, where the contract is traded, guarantees each trade happens. Right? To cancel the contract, an offsetting trade is made in the pit. A trade of a futures contract may experience a gain or a loss. So this is some basic stuff about futures which you can read when you have time. In general, futures contracts must stipulate at least the following 5 terms: the identity of the underlying commodity or financial instrument, right? So this has to be mentioned. You need to give the quality, the weight, all the standard stuff. Then futures contract size, right? Now, for example, if you take crude oil, it can only be dealt in lots. A lot is 1,000 barrels. Futures maturity date, also called the expiry date, the delivery or settlement procedure, and the futures price. So all these needs to be specified in a futures contract. And so there are futures for anything under the sun, right? Pork belly futures, weather futures, interest rate, exchange rate, equity, bond futures. So why do you get into futures? A futures contract represents a zero-sum game between a buyer and a seller. Gains realized by the buyer offset by losses realized by the seller. Futures exchange keeps track of the gains and losses every day. Futures contracts are used for hedging and speculation. Okay, so it's just like options. Hedging and speculating are complementary activities. Hedgers shift risk to speculators. Speculators absorb price risk. Speculating with futures, you're long. Buying a futures contract today is often referred to as going long, for establishing a long position. Each futures contract has an expiry date. Every day before expiry, a new futures price is established. The new price is higher than the previous day's price. The holder of a long futures contract profits from its futures price increase. Right? So if you are long and the price goes up, you benefit. If this new price is lower than the previous day's price, the holder of a long futures contract has position losses from the futures price decrease. Right? So daily mark to market. That's what it means. Example 1, if you believe the price of gold will go up, you go long 100 futures contracts that expires in 3 months, right? So the futures price today is $400 an ounce. There are 1,000 ounces in each gold in each futures contract. And so each contract is $400 into 1,000 ounces. Sorry, 100 ounces. $1,400 into 100 ounces into the number of contracts, which is also 100. And so your position is now valued at 4 million. But your actual investment, remember, is about 110,000. So suppose your belief is correct and the price of gold goes to 420. Okay. If it goes to 420, then the stock of gold you have is 420 into 100 ounces into 100 contracts, 4.2 million. And so you bought and the price goes up, obviously you will make money. Speculating with futures. And selling a futures contract is often called short selling. Each futures contract has an expiry date. Every day before expiry, a new futures is established. If this new price is higher than the previous day's price, hold of the short position loses and price increase. If the new position is lower than the previous day's price, the hold of the short option profits from the future price decrease. Right? So if you are long and the price goes up, you benefit. If you are short, price goes down, you benefit. Second example, you believe the price of gold will go down. Right? So first thing you should realize, if it's going down, is you need to go short. So you go short 100 futures contract at 3 months. Futures price today is $400 an ounce. There are 100 ounces of gold in each futures contract. Okay, so it's identical to what we did earlier. The value of your portfolio is $400 an ounce into 100 ounces per contract into 100 contracts. That's 4 million. Suppose your belief is correct and the price of gold falls to 370. When the futures contracts expires, your position value is now 370 into 100 into 100, 3.7 million. And hedging with futures. Hedger takes futures contracts to transfer price risk. Hedgers transfer price risk by adding a futures contract position that is opposite of the existing position in commodity financial instruments. And so when the futures contract throws off cash, when cash is needed, and the futures contract absorbs cash, when cash is available. Short hedge is where a company has a large inventory that will be sold at a future date, so the company will suffer losses if the value of the inventory falls. Suppose the company wants to protect the value of the inventory, they need to sell futures contracts today to offset potential declines in the value of the inventory. The act of selling futures contracts is called short hedging. So remember long hedging and short hedging. Let's try this example, then you will understand what it means. Starbucks has an inventory of 950,000 pounds of coffee valued at 57 cents. Starbucks fears that the price of coffee will fall in the short run and wants to protect the value of its inventory. Right. So if they have purchased coffee at 57 cents, the inventory is worth 57 cents per pound, and they are expecting prices to go down and then take a hit. They should buy a futures contract which gives them a benefit if the price goes down, right? So what they need to do is they need to go short futures. Okay, so let's first see the price of inventory. 950,000 into 0.57. This is today. There is a coffee futures contract at New York Board of Trade. Each contract 37,500 pounds. And so you have total of 950,000 pounds. So that's 25 contracts. So you need to go short 25 futures contracts. Coffee with futures price 3 months expiry is 58 cents per pound. So your inventory, you need to go short futures 25 contract into 37,500, currently valued at 58 cents. This is the label 543, 750. For the next month, price of coffee falls. Starbucks sells its inventory at 51 cents per pound, right? In 1 month, inventory is worth 950,000 into 0.51. Futures is worth 52 cents. It's 25 into 37,500 into 0.52. So this one, remember, they have sold, huh? Okay. Starbucks has sold futures, so if they are sold futures, they are long dollars. Here they have bought inventory, so they are short dollars. Yeah. It comes to 487, 500. Right. So they sold and made 543, 750. They can buy it back at 487, 500, meaning they make profit. of 56,250. Whereas in this case, $484,500. Now it's worth $484,500. Whereas it was worth $541,500 earlier. They will lose 57,000. From inventory, they have lost 57,000, but futures they will make 56,250. If you add up the two, they will make a $750 loss net. But if it wasn't for the futures contract, they would have made a loss of $57,000. Now they end up with 750 only. So they did well. Okay. So long hedging. The question is, a company needs to buy a commodity at future date. Companies suffer losses if the price of the commodity increases. Right? So it means you need to buy futures contract, which benefits you. The price goes up, meaning you need to go long. Suppose the company wants to fix the price that they will pay for the commodity. Buying futures contracts today offsets a potential increase in the price of the commodity. The act of buying futures contracts to protect them is called long hedging. And so let's do this example. Nestle plans to purchase 750 metric tons of cocoa next month. So they want to buy cocoa next month, 750 metric tons. Price of cocoa they fear will, which is 1,400, will increase before they acquire. They want to fix the price. Right? There's a cocoa futures contract. Each contract 10 metric tons, meaning they need 75 contracts. Cocoa futures 3 months is 1,440. It's inventory today is worth 750 into 1,400. It's 75 contracts into 10 metric tons per contract into 1,440. Right. For the next month, the price of cocoa increases and Nestle pays 1,490 for its cocoa. So if the price goes to 1,490, they will lose. 1,400, if it increases, they will lose. $1,050,000 they should have paid, but they end up paying 1,117,500. Okay. They should have paid 1,050,000, but they end up paying 1,117,500. So they will lose effectively 938,250. Sorry, 67,500. They will make a 67,500 loss due to the price increase. But futures price also increases. Now they have gone long futures, that will also increase in price. Goes up to 1,525. they have a price advantage of $1,080,000. So if you add these up, they will only lose 3,750. Okay. Right. So we have run out of time. So what we'll do is we'll close for today, and we will continue from here next week. Hopefully next week we will be able to